Hello, this is Group 31 being presented by Niven Sibula. As our title states, effects of internal control systems on financial performance of public institutions of higher learning in Zambia. Introduction. Internal control systems is a process effected by an organization, board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of effectiveness and efficiency of operation, reliability of financial reporting, and compliance with applicable laws and regulations. Hago and Colbert 2016. Financial performance is a subjective measure of how well a firm can use assets from its primary mode of business and generate revenue. Aim of the study: to assess the effects of internal control systems on financial performance of public institutions of higher learning in Zambia. Motivation of the study: majority of these studies have concentrated on different industries, while others have concentrated on a mix of listed firms of their localities. In addition, the studies employed different methodologies, and such studies may not be generalized to the study context. Therefore, the study sought to investigate the relationship between internal control systems and financial performance of public learning institutions in Zambia. Problem statement: according to Kesty 2010, efficient internal controls creates an organization confidence in its ability to perform or undertake a particular task and prevents errors and losses through monitoring and enhancing organization and financial reporting processes, as well as ensuring compliance with patent laws and regulations. Moore 2012 studied the impact of internal control on the financial performance of private hospitals in Nairobi and established a significant relationship between internal control system and financial performance. Several studies have been carried out on internal controls, globally, regionally, and locally, on the effect of internal control systems on profitability of diverse firms. But there has been no research done on effects of internal control on performance of public institutions of higher learning in Zambia. Higher learning institutions in Zambia face a quite number of challenges during internal controls in performance, like struggles with liquidity, financial reports are not made timely, fraud, and misuse of institutional funds. So looking at this point, I may elaborate more concerning the internal controls. So examples of internal controls: segregation of duties, fiscal controls, policy and procedures, transaction and activity reviews, information processing controls. And hence, when we look at the internal control, we find that there is an aspect of internal audit. So internal audit initially offers risk management and evaluates the effectiveness of a company's internal controls, corporate governance, and accounting process. And hence, when we further look at the challenges they face, which are risk, fraud, late preparation of financial reports, and theft, I would like to define two among the mentioned, which are risk. Is the possibility of losing money on an investment or business venture. Some include credit risk, liquidity risk, finance risk, and operation risk. Fraud is the falsifying balance sheets, income statements, and cash flow statements to mislead people who need them. Hence, this study therefore sought to answer the question: what are the effects of internal control systems on the financial performance of public institutions in Zambia? Objectives. The general research objective of effects of internal controls on the financial performance of public lending institutions in Zambia are the following: to assess the effect of control activities on financial performance, to establish the effects of risk assessment, to evaluate the effects of control environment, to find out the effects of information and communication on financial performance, to explore the effects of monitoring on financial performance of public lending institutions in Zambia. Conceptual model. Several theories have been used to explain the link between internal controls and financial performance. The agency theory was applied to this research. Agency theory was developed in 1976 by Jensen and Mickling. This theory is an agency relationship as a contract under which one or more persons engage another person, the agent, to perform some service on their behalf, which involves delegating some decision-making authority to the agent. According to agency theory, a firm consists of a nexus of contracts between the owners of economic resources, the principals and managers, the agents, who are charged with using and controlling these resources. Further, the theory recognizes that any complete information about the relationship, interests, or work performance of the agent could be adverse and a moral hazard. This theory is applicable to this study simply because internal controls is one of the many mechanisms used in business to address the agent's problems by reducing agent's costs that affects the overall performance of relationship as well as the benefits of the principal. Hypothesis. We look at hypothesis 1, hypothesis 2, hypothesis 3, hypothesis 4, and hypothesis 5. We see on how the influence and the impact on which the objectives have concerning the financial performance of public learning institutions. Conceptual model. The independent variables, we have the control environment, risk assessment, control activities, information communication, and monitoring, while the dependent variable is the financial performance. Research design. We've got five steps in the research design. The research design we used was the survey design. Research strategy, we use the quantitative approach. Then the population, our target population was staff members from public learning institutions under the accounting and the finance department. Then the sample size, we had a sample size of 91. Data collection tools, questionnaire with a 5-point Likert scale was used, supported by factor and reliability analysis. Then the data analysis, factor and reliability analysis, correlation analysis, clinical regression was used. Findings and interpretation. Pilot study results showed that questions on risk assessment, control activities, information and communication, financial performance monitoring, internal control systems had a positive correlation among the variables. That's how we have been able to see from risk assessment to internal control systems, they are all positively correlated. Results sample profile. When we look at gender, we see that there was high response rate by the females as compared to men. Age group, we see that a high number of response came between the age of 20 to 30. Level of education, we see to say a high number of response was done by degree orders. Number of years respondent has worked in an institution, we see to say the highest number of response came from people who've worked between 2 to 5 years. The mean and standard deviation correlation. On this one, we're able to tell to say when we look at the numbers from 1 to 8, we're able to see to say the figures, the stars which are being shown on these figures tell us to say the stars we are seeing tell us to say the correlation is significant. But then, as we clearly look at the financial performance with these other variables, we're able to see to say certain variables are positive and certain variables are negative. So that tells us to say financial performance has a positive, strong, and pure correlation with gender, age, control activity, and any variable which is falling under a positive correlation. While we're also able to see to say financial performance has a negative and moderate correlation with risk assessment, which shows a negative, and monitoring, which shows also a negative. Interpreting the results, we're able to tell to say there's been a positive correlation among the results which are being shown on the risk assessment, control activity, information and communication, monitoring, and opportunities. Then further to state on this also, any correlation above 0.3 and below negative 0.3 is considered to be significant. Interpretation. Effectiveness of internal control and financial performance is very important because the task is to prevent and detect fraud in the organization. A strong financial performance enables a transaction to be traced from its inception to completion. Internal control ensures that transactions are approved and executed only by employees acting within the scope of their authority granted by management. Hypothesis testing table. This shows the results on the effect, influence, and the impact. The objectives of this study has on the financial performance of public learning institutions in Zambia. So we're able to see control environment, it is supported because the beta is positive. Risk assessment, it is not supported because the beta is negative. Control activity is supported because the beta is positive. Information and communication is supported because the beta is positive. Monitoring internal controls is not supported because the beta is negative. Significant implications for scholars and policymakers. The management of public learning institutions as well as policymakers will be assisted by the findings of this research to identify gaps within the systems of internal controls in public learning institutions. The higher education sector will gain a competitive advantage by improving their operations and quality of services to their clients better than their competitors. Limitation and future directions. In future, these longitudinal studies conducted annually would help to monitor progress in their internal control systems on financial performance of public institutions of higher learning in Zambia, to improve generalizability of the conclusions compared to studies for public and private institutions. We need to also test the applicability of the other models. Conclusion. Aim of the study is to assess the effects of internal control systems on financial performance of public institutions of higher learning in Zambia. Thank you for listening.